Tencent is everything in China. Everything you do on your smartphone, it runs over Tencent. It's so great, Elon Musk wants to turn Twitter basically into the Tencent of the West. So let's look at Tencent, how it is recovering, and if it is a buy right now. The company is back into growth, 10% revenue growth. It's not fantastic revenue growth, but it is picking back up. And we can already see the revenue growth would be much higher if the Chinese market would be better. The social networks and domestic games, which is both China, are not growing fast. Stuff like international games is outperforming the Chinese market. Online advertising, 20% growth is great, but it is coming off very low comparables, so the 20% is not something you should expect forever here. However, fintech is still doing great. Fintech is becoming such an important part of the business, and I think if you look at Tencent, you should look especially at their fintech business. But half of their business, which is in China, which is the networks, which is something like WeChat and their games, that is just not performing well, and that maybe shows the weakness in the Chinese economy. We saw it from other companies like Alibaba, that the Chinese market is just not going as well right now. So if you think that's gonna recover or not, China is definitely not gonna go back to the 8% GDP growth numbers, but even with that in mind, this is very weak growth. Stuff like fintech is making up more and more of their business. The social networks and domestic games, they are slowly declining in relevance. They made up 48% before, and now they're out in 40% in 3 years. That is a fast decline. Meanwhile, fintech gained 8% more revenue share. So long term, I think that is good. The fintech business is just way superior. Stuff like WeChat, it is just maturing. Everyone in China is already using WeChat. There is no room for that to grow. If you don't know what exactly WeChat is, it's everything, really. Imagine all the apps on your phone. That's WeChat. So it's very hard to grow if you already own everything, but the fintech business still has room to grow. And when we look at the margins of a fintech business, the gross margins are going up and up and up. We're now at 40% margins. So where you have online advertising with highly volatile margins, which we saw last year, when we now see fintech with way more reliable margins and potential for way higher margins than advertising. I think that is gonna be the one jewel of Tencent that is gonna catapult them forward. Expenses are mixed. In some segments they're up, in some segments they're down. Overall, the expenses are not growing faster than revenue. Their net margin is also starting to finally improve. And once again, mostly because of fintech. Most people still see Tencent only as WeChat and their gaming segment, but it is so much more by now. Free cash flow is also recovering very nice, but once again this is coming off a 1-year downturn, so 85% growth is not normal. But you have to remember, Tencent is a technology company, so they pay a lot in share-based compensation, so you need to deduct 5.4 billion yuan from this free cash flow, where we would land around 45 billion yuan in free cash flow this quarter, which is $6.36 billion, so that is not a bad free cash flow at all. That is around 25 billion annualized, so a great free cash flow. They also are continuously to buying back shares, but if we can see 14 billion yuan buybacks, 5 billion dilution, that is 9 billion in yuan in buybacks, that is not a lot. Their shares outstanding were reduced by not even 1% year over year, so where you have companies like Alibaba who are buying back 2 to 4%, the share buybacks here are basically irrelevant. But you have to remember, Tencent paid out a lot in dividends, especially by divesting Meituan. So instead of higher buybacks, you got a higher dividend here. It depends on what you prefer more. And also something you can notice with the Chinese companies, they're building up cash positions. They have increased their cash position by 50 billion yuan last year, which is $7 billion. It is not as much as Alibaba, where they basically have tens of billions in cash, but we notice the Chinese companies are becoming more conservative when it comes to their balance sheet. They're also showing you their investments in listed companies, which are worth 65 billion, and unlisted companies around 48 billion. But you have to remember, especially with these unlisted companies, they have not marked these companies down since interest rates went up, and a lot of these companies are high growth, no cash flow companies. And what has happened to these companies in the last few years? Valuations have crashed. Most of them have went bankrupt. So this 48 billion is a very aggressive assumption. I wouldn't count on this. The listed companies at 65 billion, more realistic, but a lot of these companies, in my opinion, are still overvalued. And I want to be conservative, so even if I say that it's around 100 billion of value, those are risky stocks they own. I would mark it down to around 50 billion. Currently, Tencent makes $2.6 per share in free cash flow. I think 10% growth rate for the next 10 years is very realistic. Even if our revenue growth is probably gonna be around 8 to 10%, their fintech business is gonna make up most of that, and here we're gonna have growing margins. Plus, you will have slight reduction in share counts of 1 to 2%. 15 multiple, it is a fantastic company, but it is Chinese. There is a risk with these companies. They are gonna trade at lower multiples, no matter if you think Chinese stocks are undervalued or not. 10% required return, payout ratio of 15% with a little deduction due to taxes. We would come to a current value of $38 per share. I added the investment value per share of around 6 to that, which would bring us to an intrinsic value of $45, 10% discount from where it's trading today. Now, do I think this is a conservative assumption? The revenue growth, not so much. Maybe the investments. If the investments are gonna be worth as much as they have them on their balance sheet, that would be around double from what I have right now. Then maybe yes, it would be a slightly better buy. Now, what if they're gonna grow faster? They're gonna go back to revenue growth mode, 14% and 12% after that. 20 multiple, it's gonna go back to where it was before, because you know, it is everything in China, so maybe higher multiple. Then we would have $64 per share. But it can also easily get worse. 8% growth rate for the next 5 years, 6% afterwards. Those are not very, very conservative assumptions. If something goes wrong, especially with the fintech business, regulation can always happen there in China. So if I stamp down on the fintech business, that could easily make this scenario a reality. Then we would be at $25 per share. Now, would I want to add Tencent to my portfolio right now? No. I already have China exposure with Alibaba, which I think is a way better buy. Even if I didn't have Alibaba, I wouldn't want to add Tencent. The valuation here is just not in my favor right now. I can have way better buys, which have way less of the China risk, so I'm gonna sit this out. It is a fantastic company, but not in my value range. What do you think about it? Write it down below. Have a good day.